Welcome to the Nick Show. This is the place where we explore big ideas with people having a big impact on our world. I'm your host, Nick Hilaris, serial entrepreneur, author, early morning riser, and seeker of truth and wisdom. Join me as we explore the journeys and discoveries of fascinating people who are literally unlocking the secrets to creating a life of both success and fulfillment. Each episode will arm you with insights, ideas, and practical perspectives on what it takes not only to be financially and personally successful, but also how to start having authentic impact on the world around you. Hi, everyone, and welcome back to the Nick Hilaris Show. Our summer finance series continues. Up next is Mike Green, the chief strategist of Simplify Asset Management. Mike is a very sophisticated global macro investor with an incredible track record and one of the most respected thought leaders in all of global finance. As you'll see in this episode, he has a knack for taking very complex ideas and explaining them in ways that we can actually understand. I wanted to have Mike on the show because he has some really important perspectives about investing, the direction of the economy, potentially consequential nuances in market dynamics, and much, much more. I had high hopes for this conversation, and it did not disappoint. We covered fascinating ground and talked about everything from brewing science of trouble in real estate and high yield debt, to China's demand problem, to the surprising relationship between the rise of passive investing and the problem of capital misallocation in the broader economy. As you'll see in this episode, Mike's understanding of these issues is just at a different level. But like all true great investors, he approaches things with both a sense of self-understanding and humility. With Mike, you won't get hype or hyperbole or anything like that, but you will get incredibly deep understanding and nuance. I, for one, would take that all day. Thanks for tuning in, and please enjoy. We have a special guest today, market expert, theoretician Mike Green, whose current role is the chief strategist at Simplify Asset Management, also a very well-respected and well-known financial commentator, popular on Twitter and Substack.
Unlike a club, right? Any place you're looking for cool people, you're not going to find me, but you might find me on Twitter. So there you go.
Yes, you're incredibly famous in the FinTwit world. You have a huge following, and I've been following your work for years and have always wanted to sit down and talk with you. And so I appreciate you coming on to the show.
It's a real pleasure to be here, Nick.
I figured a good place to start, because I've been listening to some of your recent public appearances on different podcasts, is a space where I think we kind of probably have the same view, which is despite all of the headlines and despite maybe the market action, there's problems brewing in the economy. And I'm in real estate. I thought maybe we'd talk about that, where you recently were talking about the corporate debt problem. Well, the real estate debt problem is equally huge and equally real, and I'm living and breathing it every day. So why don't we start there? What are your thoughts on real estate?
Well, I think, unfortunately, they're very similar in their construction. We all know that interest rate hikes work with long and variable lags, right? But nobody ever really stops to quantify what does that mean and why does that happen. If you look at real estate, for example, a hike in interest rates doesn't affect the average person who has a 30-year fixed rate mortgage unless they're trying to transact, right? Then when they try to enter the market, they realize that the prices are no longer as high as they were before. Or it doesn't do the same thing happens with a corporation. If I issue fixed rate bonds 2 years ago that don't mature for another 3 years, I have no impact on my income statement, my actual cash outlays associated with the fact that interest rates have now risen, right? It may modestly affect my customers. It may reduce demand for various forms of capital investment, depending on the type of industry that I'm in. But that slow moving dynamic doesn't really play through. The reason that becomes a problem is that we've looked for interest rate hikes to solve the inflation problem, right? To have this immediate slowdown effect. And we're just not seeing it. We're not seeing the slowdown yet. But what we are, because we're not actually experiencing many of the impacts. And if anything, the hikes in interest rates in some situations are actually contributing positively, as people suddenly with cash in the bank account are now switching that over to a money market mutual fund and suddenly getting 5%, right? They actually feel relatively flush because their incomes have risen associated with the cash that they have on hand. So all of these things are playing through. They're just happening in a very slow manner. The problem that occurs exactly as you're seeing in real estate, and in real estate, this tends to manifest itself first in construction loans, and then it manifests itself in the operating dynamics of a lot of forms of commercial real estate that don't have fixed rate loans. Instead, they have loans that reference a trailing index. So my guess is you're starting to see in the real estate space, people face the reality of the cap rate that they underwrote the property at, that they may not even be realizing because of much lower occupancy. Although again, occupancy doesn't immediately collapse, right? It's just people stop showing up to work. And then when their 10-year lease is over, they're like, yeah, we didn't want that, right? So there's very little opportunity for it to show up in the data until it suddenly does, right? And then you basically hit a wall. When your debt refinances and it crosses over the cash flows that you're generating from the business, you have every incentive in the world to get out of that. How do you get out of that? You hand it over to the lenders. And that's exactly what we're seeing. There are ways, if the market was really strong, you wouldn't see them handing over these properties to the lenders, which is what we're seeing, right? You'd actually see them go to the market and say, hey, we're going to try to sell this. We may take a loss, but it's not going to be a total wipeout. What we're actually seeing is them saying, we're not only going to be totally wiped out, we want to just hand it over and not even try to explore it, because if we try to explore it, we're actually tipping our hand and revealing that we're going to take losses in the rest of our portfolio, right? So everybody is involved in this subterfuge right now that basically says, well, let's try to avoid price discovery wherever we possibly can.
Well articulated. I feel like the crazy thing about my space is that going into the hiking cycle, the entire world was essentially priced. Every single real estate transaction for a decade was price predicated on interest rates being low forever. And so you have this phenomenon where almost across the board, cap rates were sub 5. And in many good markets, they were like 3. Well, 3 and 5 cap rates, they make sense in a world where interest rates are 0. But when interest rates are 5 and you can only borrow at, let's say, 6 or 7, everything in the world has to be repriced. The math is just inevitable.
Well, it's inevitable math, but as long as you don't actually have to realize the loss, right? As long as you don't turn around and say, okay, we tried to sell the property, we got no bids for it, or we tried to sell the property and it's down 70%, which is much of what we're actually hearing from properties that are considering going into market. The current estimates are that the city of San Francisco has completely wiped out the equity value in its commercial real estate, which should be no surprise. But we're not seeing behaviors that look like that, other than the zombies wandering the streets. And these are really significant losses that don't matter until they're realized. And the minute they're realized, all of a sudden, everybody now has to turn around and justify why they aren't realizing them as well, right? And the Fed knows this. The Fed is actually explicitly engaged in conversations where it's asking lenders to be gentle and to be constructive in their workouts with those that have borrowed from them. But no real estate sector can handle this sort of write down. We genuinely don't know what the value of commercial real estate is anymore. Whether it's a mall, whether it's an office building, or even for that matter, once we begin to recognize these things and we start to take these losses, what really does a residential real estate look like in an environment like the city in New York or in San Francisco, when suddenly you're wandering around and there's all sorts of boarded up properties? And that's catastrophic to the standard of life. So we just don't know is the quick answer on this, but it is really hard to fight against the logic of the math. But man, everybody seems to want to, because we're in this data-dominated world where we look at something like the Zillow Observed Rent Index, right? And people are like, oh, look, it's turned up, without actually looking at the fact that it's not a seasonally adjusted number, right? So guess what happens to rents when kids roll off their rents in June and take on new leases that start in July and August, right? Well, typically they go up, right? Why? Because it could be a 2-year-old lease or a 3-year-old lease, right? And all that plays through to these types of observed rent indices that we just don't have an awful lot of data on their long-term performance. And people are basically, myself included, we're all biased to look for information that confirms our point of view as compared to disproves it. But it leads to all sorts of crazy experiences too, right? So if you look at publicly traded home builders, you'd be like, oh man, home building is going gangbusters, right? Except for the fact that it's not. Independent home builders, small local home builders are basically dying on the vine. And the national home builders, they're able to offer teaser mortgage rates that are in many cases 3-4%, 300 basis points, 400 basis points below what the current level of interest is. They'll offer them for 2 years. If you just do the math on the implications of that, it's like a 10% discount, right? Well, they just crank prices up by 10%, right, to offset that because nobody can compete with them. So the national home builders have taken, an unfathomable amount of market share in just the last 12 months because they're the only ones that can actually afford to make those types of commitments. They're the only ones that have captive mortgage units, right, that are able to actually finance those types of mortgages and say, yeah, we'll do a teaser rate at this valuation. We don't need to go through the bank approval process. We don't have to hire an independent appraiser. We don't have to do any of those things. So we're seeing very confusing data.
And what's scary about that home builder phenomenon is that the home builder space was broken before this. So the GFC had done a number on it, and the national home builders at that time took a bunch of market share from independents. So it was already struggling. And they were really the only players in town. And there was the beginning of a resurgence in the small players who are really important for cities like Los Angeles, where there's small tracts of land, less important maybe in Texas or Florida, but in big cities and cities that are doing infill type strategies, like you need independent entrepreneurial home builders, and they can't compete. They can't do these buy downs.
Let's go into the multifamily space, for example. Philadelphia is trying to rebuild. This happens to be a city I'm aware of, right? So Philadelphia is trying to rebuild its riverfront, right? The Delaware riverfront. There's been an eyesore that has been separated by freeway for 50 years, sort of thing, almost a Robert Moses type dynamic, right? Well, they're finally moving forward on doing this, and the Durst organization is supposed to build a 340-unit multifamily property, and they're like, yeah, we're out. We can't get financing, right? Does that show up? How does that show up in the data sets? Well, it doesn't actually, because nobody was really hired for it yet. It's not really in the construction, but it means that we're going to see that slow down in the future as projects roll off, and there's nothing to replace it.
It's almost like we're setting up. I'm active in multifamily myself, and we own here and we own in Atlanta. And it feels like we're setting up for another round of inflation. And I can't predict when it's going to happen, but because of what you just articulated about the supply consequences of this environment, all these deals that we even have some ourselves, we were planning on doing, but man, can you really justify breaking ground on something new right now? It's almost impossible to make that risk adjusted decision.
Which is where you now end up in the very interesting phenomenon of, well, who can take that risk, right? You as a smaller multifamily home builder probably don't want to take that risk. You don't want to be the guy that's like, I'm trying to gain a whole bunch of market share right here, right? But if you're a national home builder and you overstretch yourself a little bit, well, you can just fire a whole bunch of people. And you can basically negotiate down your banks, and you can walk away from a lot of land options that you've picked up if it gets particularly bad, right? You've navigated as a national home builder the worst of the global financial crisis. I just want to be very clear. I don't think that for home building, this is the same thing, right? We don't have the extraordinary levels of speculative real estate, particularly in single family, that we had that time around. But on the flip side of it, we do have basically baby boomers and their children who are increasingly trapped, right? And can't relocate for jobs, can't afford to buy a new house. And it's what I literally started calling it over a decade ago, the Italianization of America, where you end up with very high levels of home ownership because children stay at home and inherit the homes from their parents. And you've got much higher levels of home ownership in Italy. When was the last time you heard somebody talk about housing starts in Italy? Right? Nobody cares because there's no net demand for new housing. In fact, Italy, and I would argue that you'll probably end up seeing, dynamics like this around the United States eventually. Italy is actually in a big push selling homes for $1 to try to get people to move into increasingly abandoned villages. Right? So this whole, housing only goes up sort of thing. And we've now got over a decade that's on the other side of that. To China, same story, right? Massive overbuilding with a demographic collapse sitting in front of them, right? Places like South Korea, and I want to be clear, this is an equal opportunity housing crash that is underway. You go to places like South Korea and household formation and fertility rates have collapsed. Korea is now 0.7 children per woman. Right? That's not even, replacement is 2.1 because of various problems that go on and people not reproducing. They're 1/3 of replacement level. And this leads to a wholesale collapse. What do you think happens to demand for housing in South Korea under those conditions? It's just absurd.
I grew up in Detroit. It's going to look like Detroit in the early 2000s. If you build housing for 2 million people and then they disappear, then you get the same phenomenon, houses selling for nothing, essentially.
You get houses selling for nothing, which then means you can't afford to borrow to build a house, right? Or to buy a house. You also then end up with a very stagnant entrepreneurial economy because home building has traditionally been one of the few things that somebody with a reasonably modest level of individual skill can actually get done. And if you're a general contractor, you didn't go to MIT for a PhD. You went to the School of Hard Knocks and you may have studied electrical systems at some point, but highly doubt you're actually, going to the Harvard Business School to learn how to, manage your small business operation. You've basically worked your way up through the system and you found yourself in a better position than many of the other skilled contractors that were along the way. And you figured out how to do this job. But if you can't borrow to build, then you can't do it. And Detroit is a perfect example. What has actually started to lead to the Renaissance in Detroit, or what was a Renaissance in Detroit, was the city of Detroit acknowledging we're not as big as we used to be. We can't provide services to 40% of the landmass that used to represent Detroit. So effectively, it's abandoned.
They were concentrated before, so they had the auto concentration. And this downtown resurgence was built around mortgage companies. And now they're getting absolutely crazy. You couldn't even make this up if you tried. So they're in trouble right now, obviously, because it's hard to run a mortgage business when every house in America is unaffordable to the average family.
That is the part that we know. I just saw a commentary from somebody earlier today whose, observation was the housing market is robust. And I'm like, if that's really what you actually think, I don't know how else I don't know where to start a conversation, right? Because what we're actually seeing is, and this just happened, I think you followed some of my shenanigans long enough to know that I sold my home in Marin. And I literally was like, hit the bid. I don't care. Get me out. Because what's actually happening in Marin County, California, is that the fewest number of homes sold ever, right? There were very few new homes built. There's even fewer that were listed. So those homes that were being listed sold. But what will drive listings in Marin County? Unemployment. That's what always drives it. And Marin County does not have people moving into it now. Marin County's population is actually shrinking, right? And the only reason why somebody could afford a property like mine, again, I was relatively fortunate, but the only reason somebody can afford it is because they're moving for a job, right? They've got a great new job and going to work for some technology or finance firm, which is all that exists really in Northern California at this point. And they're able to go in and buy something, right? And in limited supply, they'll bid up for it. Man, my house is already down according to the Zillow metrics from where I thought, and my wife thought we were being crazy and selling it, right? Because she's like, oh, how could we walk away from the potential for it to rebound? It's not rebounding.
When did you sell that one?
I sold it in June.
Okay. So after the hikes had happened, and yeah.
That's part of what I think people need to also understand is that life choices eventually intrude. And if you're not capable of actually executing those life choices because you're trapped in a mortgage, you can't move to be closer to your grandchildren. Your children can't find housing that is relatively attractive because of undersupply. And so their bias is just, oh, I'll stay with you and I'll do remote work from home, right? Those are all suboptimal conclusions and outcomes for the U.S. economy. And we don't yet know how important those are going to be because we haven't lived through it yet.
And this housing thing in particular is super important for America because what you were describing about essentially people being either locked into their houses if they happen to own. First of all, if they hit the lottery and they own an asset in America, that's one thing. But those people are going to be financially restrained from selling because the economics are so backwards right now. And then there's the younger people who they couldn't afford a place before, and they certainly can now. And so it's taken some of the dynamism out of the economy, and it can't be good for the economy long term. We don't know what it's going to do, but it's obviously not a positive in my view.
So I think you're hitting on the really important point, and this then bleeds into a lot of the other work that I do, which is when it's obviously not good for the economy, right? The fact that prices remain relatively elevated, that's not signs of robustness. That's actually signs of fragility. right? It's the equivalent of basically saying, well, I can't sell my house, but if I could, it'd be worth X, right? Well, you can't sell your house, so it's not worth anything really, right? Or more accurately, you're not willing to hit the bid, right? Which is probably down quite a bit.
Maybe this is a good time to dovetail into some of your other thoughts, because this phenomenon that we just went through in real estate is also playing out in corporate debt, for example. I think one of your recent appearances, you talked about how like a humongous percentage of corporate debt is basically not going to be able to be refinanced because these companies are going to be underwater.
Unfortunately, that's right. A lot of people will talk about things like, well, high yield is higher quality because the companies are bigger, they're more profitable, they have higher levels of EBITDA than they have in the past. But the simple reality is that they also are much more exposed to dramatically higher levels of interest. Right. And that's what we've actually done. We've gone from, EBITDA coverage ratios that were reasonable when you had high yield printing at the lowest levels in history in terms of yield, which is where many of them issued. But now that we're actually facing a combination of fundamental deterioration, a slowing U.S. economy, and a dramatically higher interest rate, and the dynamics of a regulatory change in 2017 that means that much of the increase in interest rates is not going to be tax deductible. Right, the effective interest rates have exploded and should be leading to people pricing these for distress, which is ironically actually what's showing up in the bankruptcy statistics, right? So we're seeing a surge in actual bankruptcies, but it's not showing up in credit spreads yet.
Hey guys, this is Nick. I wanted to take a quick break from the episode to share some exciting news. In addition to the podcast, I want to make you aware of some additional content we're putting out. And best of all, it's 100% free. Our Profit Plus newsletter consists of weekly insights about what it takes to find meaning in the pursuit of modern success. This is the place where we explore big ideas at the intersection of markets, business, politics, and life, as we seek to empower our readers to have an authentic impact on the world. If you're serious about finding fulfillment amid success, then definitely check out these additional insights. Just go to subscribe.nickhilaris.com. Again, that's subscribe.nickhilaris.com. Now let's get back to the episode. The real estate, we didn't talk about this, but it has a problem for the banking sector that just already kind of wobbled, right? We had these bank failures. Who owns the high yield corporate debt that's not really reflecting reality as of now, at least?
There's a lot of different holders, but probably the biggest is going to be the insurance companies. And they are similar to the Silicon Valley banks of the world, right? They're effectively holding it under hold to maturity type framework. And as a result, they don't have to recognize a loss if they don't want to, unless they have to transact, right? And so that's where the problems always emerge, or unless an actual event like a bankruptcy forces them, a downgrade forces it out of their portfolios. And so that's the key risk that you run into, forced selling dynamics. And that's always kind of a critical risk in markets. Again, if you and I are both holding on to properties that are distinctly undervalued, and we never have to transact, right? You and I have cash cushions that say, oh, we're totally fine. We don't need to worry about it. We'll just wait for it to come back. Then what you end up with is no transactions, but you don't also see any form of distress. If I suddenly am like, oh, hey, I'm really sorry, Nick, but I have to sell, you have two choices. You can either show up and pay me what I was carrying it out on my books, or the equivalent of what you're carrying it out on your books, or suddenly there's a comp out there that allows your investors and your lenders to be like, Nick, I don't think this thing's worth what you think it's worth, right? We underwrote it at X. We're not going to lend to you on a refinancing at, X times 1.5, right? And so all these things start falling apart.
And in real estate, it's happening slowly. You see it in the news, but it doesn't sound like in the high yield yet that we're seeing any of these events that would cause a write down or a change in status or whatever, other than maybe this bankruptcy statistic, which you just referenced.
Well, the bankruptcies are happening, right? We actually know that. And we know that it matches the historical data sets in terms of traditional credit models. But a credit model that diverges from market pricing has two possible interpretations on it, right? One, it's wrong, or two, it's a premonition, right? It's a prediction and that's going to be realized. You can't possibly know until the events actually occur one way or another. And so there is a scenario in which all the holders of this paper are like, yeah, we never need to sell. There's no reason for us to do this. When you start to actually see the distress begin to percolate, when you see a couple of large scale bankruptcies, it can change very, very quickly. Right. And even in sectors in which people have convinced themselves that there's fantastic opportunities out there, cruise lines, for example, right? Cruise lines are coming back in a big way. There's going to be tons of growth. Man, Nick, do you realize all that growth is contingent upon China? All the growth in the cruise industry is contingent on China emerging. I'm going to take the under on that.
They're struggling. Their data, who knows if their data is accurate, but it looks like they're struggling and they're seeing maybe even outright deflation coming, right?
Well, the one thing we know is their data is not accurate. What we don't know is which direction it's not accurate at any point in time. Their data technically says that they are in deflation. We're seeing evidence of many types of deflation in the United States. The producer price index is now down on a year-over-year basis. Many forms of volatile prices, particularly energy, are significantly down on a year-over-year basis. What's not down are the lagging metrics, things like owner's equivalent rent that makes up nearly 40% of the CPI, right? And many of the slow-moving aggregates within that still reflect the pricing environment from 2022 in which people were saying, well, I can take some price increase, right? There's also a bunch of ridiculous measures within the CPI and PCE, for that matter, that actually incorporate interest rates into their prices, right? So if I look at the CPI index for the cost of bank services, right, the crazy way that the cost of bank services are calculated is not a function of, did you have to write a bigger check to your bank to keep your checking account open this last year? Right? It's an imputed cost in which they say, what's the spread between the rate available on the risk-free government bond and the rate that is being paid on deposits, right? And so the imputed level of bank services has exploded in terms of the price without me writing any more money to my bank. I'm not paying cash more for the services. It's what's called imputed, right? This is the flip side of many of these types of metrics like OER, owner's equivalent rent, that people were pointing to back in 2021 and saying, the data is all wrong. They're intentionally obscuring it, right? Well, they're doing the opposite this time around.
That's interesting. That bank number, what size of CPI would that be? Is that like a tiny little blip, or does it actually show up in the number?
That is tiny, but when you see numbers up 100%, even a tiny number is contributing, right? But the much more important things would be all sorts of imputed metrics. What is the price of automotive leases, right? Well, if automotive leases incorporate the price of the financing, which they do, right, then they've gotten dramatically more expensive. But that's the Fed chasing its own tail, right? So this is happening over and over again. We've seen this in other countries. The UK, for example, is seeing their home price index go up an awful lot because it's actually tied to mortgage rates, which have gone up an awful lot, causing, therefore, the perception that there's a runaway inflation problem. Now, the UK actually does have a runaway inflation problem, or has significant inflation issues. But that is not really what we're actually seeing. Is not at all reflective of the actual underlying data. And until central banks around the world suddenly wake up and are like, oh, okay, well, now we have a credit event, we need to respond to it, or we've got a significant downturn in the unemployment market, we need to respond to it, you're not going to see those things meaningfully fall. They may flatten out, but they're not going to meaningfully fall.
What do you think of this comment that you find a lot in FinTwit and maybe even in the mainstream financial news, that the Fed is deliberately attempting to tank the employment market to get rid of this inflation and get back to 2%?
Well, I think there's obviously some truth to that, right? So when you say tank, they're not actually trying to make sure that everybody gets fired. But what they are doing is they're operating under a model in which they presume that inflation is a function of labor cost increases, right? What's called a cost push model. It's also, there's a relationship which a lot of people think is theoretical in its construction, but it's really more of an empirical observation that has been remarkably unstable, called the Phillips curve, right? Which is the relationship between unemployment and inflation. That is a calculation that was done in the 1950s and the 1960s that posited a stable relationship between the degree of labor slack and the levels of inflation. We just haven't seen that actually borne out in any empirical framework. And I would point out to people that inflation is decelerating rapidly at 3.5% inflation, at 3.5% unemployment, in the same way that it accelerated rapidly at 3.5% unemployment, right? So I just don't think that there's a legitimate, strong relationship there. What there is a relationship is between things like the unemployment rate and job openings, right? So that is actually a durable and stable relationship. And there we're actually seeing the employment market begin to weaken. We just got the NFIB's small business data sets today that suggest that they're reducing their hiring intentions. It's still not terrible, but they're reducing their hiring intentions. We've seen this amongst large corporations in particular, where they've dramatically reduced their hiring intentions and have significantly reduced the number of employees. Is why Google employees, for example, you've seen them get laid off in places like San Francisco, right? Now, all of that can resolve itself over time, but the simple reality is that those are very different characteristics, right? When the local retailer lays somebody off, they're laying off somebody who doesn't get severance, who immediately will go file for unemployment, et cetera. When somebody at Google gets laid off, they actually don't have any real awareness of the way the unemployment system works in many situations, right? They'll be receiving severance, for example, from Google. And so they'll be slow to do things like apply for unemployment benefits for the very simple reason that even if they don't file for them, they can claim them in arrears, right? So it's not like they've lost anything. And what they really want to do is go find another job. And in the state of California, for example, unemployment benefits max out at about $13,000 for any period of unemployment. That really matters if you're a retail employee or somebody who's in a clerk sort of customer-facing role. It doesn't really make that much difference if you're making $250,000 as a Google employee. You're already receiving severance. You're just not rushing out to get that extra money. Right. And in many situations, you're probably saying to yourself, well, I'm going to take a long deserved vacation because I've worked so hard. Right. And I'm going to find a job just like Google. That's, I think, going to be the terrifying part is there's not a lot of jobs just like Google. There's not a lot of jobs just like Apple. There's not a lot of jobs just like Amazon. Right. The benefits associated with stock ownership, with an appreciating stock price, options that are being granted to employees across different ranks, those are not replicated when somebody takes a job with a local consulting firm after having searched for a job for 12 to 18 months, right? They have to accept the fact that they were earning way above their potential because of whom they were working for. There's actually a remarkable amount of research that's been done on this in the United States. The primary determinant of your affluence is just how lucky you were to go to work for a place like Google or Microsoft that happened to pay you in stock options that have appreciated dramatically.
I've seen that in just my generation. I have some friends who took jobs at venture type companies and got stock and compensation. And yeah, when something goes up 1,000% or something, it puts your annual, even if you were a lawyer or a consultant and making 10% raises every year, it's nothing compared to some one-time massive hit related to the equity.
The benefit associated with that, right? I mean, people forget that if you cut somebody at 28 or 29 years old a check for $2 million, that's a life-changing event, right? That provides them with capital that allows them to do any number of things. Now, some will go out and spend it, right? And that's unfortunate that they would. So it's great for the rest of us in the economy when they do. But a lot of them are going to have that as accumulated capital that then allows them to become angel investors, right? And all sorts of stuff that we'll see. But this is going to be a rough cycle from that standpoint.
I think so. I feel like now might be a good time to pivot into the next topic that I wanted to cover with you, which is I wanted to unpack your investment process, if you will, because you've articulated so many really good ideas for the world. And the way I want to go about getting them, though, is maybe a little unorthodox. I want to go through the popular narratives of the FinTwit world and the newsletter world, and just get your take on them and use that as a way to articulate what does Mike Green really think about investing and what people should do. So that's the idea. So the first one I wanted to ask about is one of the most common narratives that you find on Twitter or in the newsletter world is this, what I call the sort of fourth turning doom thesis. And the idea around these is like, if you start to look at the macroeconomics of the Western economies in particular, but also China, you have this You can logic yourself into believing that this thing is just a giant, massive house of cards and is about to collapse. And therefore, it has these following investment implications. Usually buying precious metals and owning real estate without debt, or maybe even in recent manifestations, buying cryptocurrency. But what do they get right and what do they get wrong? What's your take on that thesis?
My problem with the whole fourth turning type narrative, and just to be clear, I think that there are actually very important observations within that type of what I would describe as pop psychology stuff, right? And I don't mean to treat that as necessarily dismissive. I just want to emphasize that, like, there's some truth there. If there weren't, right, and we didn't believe in this, in some of these dynamics, then people would just look at it and say, oh, that's completely absurd, right? It'd be like, the story of Icarus is really true. And if you put wax wings together and you flap them hard enough, you can fly. We know that's not actually true, but things like the fourth turning, or I would actually point people to the work of Peter Turchin with his cliodynamics stuff. These are legitimate concerns from a social standpoint. And I would highlight things like Peter Turchin's observation that we've effectively run out of things for the proliferating class of the elite to do, right? And you see this very explicitly in the type of employment data that we're seeing, where the rates of unemployment for college graduates have risen significantly. And even more than the rates of unemployment, I would argue the rates of underemployment for those with college degrees has risen dramatically. Labor force participation for those with college degrees has collapsed in a manner that is different than what we've seen in many other sectors of the economy, right? It would have been unthinkable 100 years ago for somebody to go to college, unless you were from an extraordinarily wealthy family, for somebody to go to college and then be like, I don't really feel like working. That's just an astonishing outcome, but it's inevitable when you have something like 50% of the population going to college, right? Now, what we've actually seen is we've seen a dramatic dumbing down of grammar school and high school that has actually created conditions under which people do really well on academic tests, right? So most people think that performance on academic tests has deteriorated markedly over years. That's actually not true. We see people doing better on academic tests, but they're not graduating with life skills, right? They don't know how to be a plumber. They don't know how to be an electrician. They don't know how to be a home economist in terms of balancing a checkbook, et cetera, because we've stripped all those things out of the curriculum in place of, okay, here's how to study for the English portion of an exam. As a result, we're increasingly seeing people go off to college that really have no reason to be in college. They're getting remedial education in college and then being told that, well, congratulations, the sheepskin diploma that you've received confers upon you the title of deep thinker, right? And they just don't have anything to really add to the conversation. Right? They should have actually gone and gotten a vocational degree. They should have become a machinist. They should have become a pipe fitter. They should have become somebody who's capable of doing something immediately where they step in without having to spend time being retrained in terms of how to enter the labor force. And crazily enough, the idea that you can go to college and then end up being a Starbucks barista or something along those lines, what an extraordinary waste when you really think about it.
Yeah, especially given the cost. The cost is blown out. It's super expensive.
Well, Larry Summers very disingenuously just tried to hit on this, highlighting that the underlying dynamic is that the Harvard degree has never meant more, and yet Harvard has actually engaged in scarcity economics, not at all increasing the number of people who can get a Harvard degree. Right. What they very much engaged in is the equivalent of being Hermes or Louis Vuitton and saying, okay, we're going to produce a limited number of these degrees and each one's going to be worth even more, which is societally a terrible solution. We had all sorts of dramatic expansion of secondary and tertiary education, tertiary meaning college, over the past 100 years, right? When we talk about people in the United States getting an education, if I go back to 1900, the average American went to 3 years of school, right? So they learned how to read, but they did not actually explore higher mathematics in any way, shape, or form, right? They didn't turn around and learn, how to properly use gerunds, for example. Nobody really cared about that. It was, can you read very basic instructions so that you can be a functioning member of society? Today, the average person has 13 years. The average person has 13 years of education. In 1900, it was 3 months of school that you were going to. Today, it's somewhere closer to 8 to 9 months. right? And so the investment in education that we've made is extraordinarily high. And the return that we're getting on that investment is actually quite low at this point.
Okay, so in your view, what the fourth turning or the Turchin crowd has right is that whatever's going on, whatever the cause of that is, maybe it's the debt, maybe it's a combination of all the things that people complain about when they think about systemic issues in the West, but it's producing a scarcity of real opportunities for the elites.
I think that's right. And I think, unfortunately, when there's a scarcity of opportunities or the elites are scared about their children's ability to maintain that status, then we start seeing all sorts of antisocial behavior. And that's really, in my opinion, what the fourth turning is about. Everybody fantasizes about the idea of a peasant-led rebellion, right? The people are going to... That's not what happens, right? Donald Trump, who's an unaccepted member of the elites, right? He's politically unaccepted. He's socially unaccepted. I lived in New York, and it sounds terrible, but from the perspective of many in New York, Donald Trump's a persona non grata, right? His wife would never have been accepted into the ladies who lunch section of the Upper East Side, right? He's an interloper. And when that's unacceptable, then you actually mobilize the resources in a populist framework and you create the dynamics that you're having with Trump that leads to social fracture. And that's really the concern that the United States has to have, is this component of social fracture that's caused by people correctly pointing to the elites and saying, well, who do they think they are?
And do you think that the fourth turning thesis, the way I see it most commonly articulated is, okay, we've got this looming crash and therefore you should sell all your financial assets and whatnot. What do you think of that logic?
I think that's a hard one to speak strongly on one way or another, right? I think that there are extraordinary risks that exist within financial markets, but I think that they're primarily a function of the structure of those markets with some demographic risks overlaid. Do I think the political dynamics or the nature of it being a fourth turning per se actually means, oh, there's a looming crash because there's a fourth turning? No, we'll have a crash just like we had a crash in 2020 and just like we had a crash in 2008. And most people forget this, but most people were pointing to 2008 and saying, oh, that was the fourth turning, right? And now here we are 15 years later, and it's like, oh, well, here's the fourth turning, finally, right? Because we had this intervening period that didn't seem to make any sense. I just think the ability to diagnose what you're actually going through, there's the David Foster Wallace analogy of this is water, right? Like you're swimming in the medium. Of course, it seems effortful when you're swimming in the medium. I grew up in the 1990s, and I remember in the early 1990s sitting there going, man, if I'd only had the opportunity to be in the early 80s, right? That was really when things were hopping in financial services. Right. By the end of the 1990s, everyone was sitting there going, oh, man, if I'd only had the opportunity to be in the 1990s. Right. And we had the 2010s. Oh, if I'd only had the opportunity during the global financial crisis or to buy a house before the housing bubble. And so we always create these dynamics. We're always swimming. Life is hard. This is, all sorts of stuff that is true. If you think there was some great and glorious American era in which all you had to do was hop into a Conestoga wagon and go travel west, young man, and don't worry about the hostile Native American tribes that were going to shoot you on sight. That was not easy. There's never an easy part in life. There's just parts in it where you're like, oh man, this is harder than I want it to be.
Let's take a quick break to hear from our sponsor. This episode of The Nick Halera Show is brought to you by Metros Capital. If you're an investor looking for direct access to real estate investments, then we'd love to talk with you. Investment opportunities at Metros Capital balance financial returns and community impact. To learn more, contact us at metros.nickhaleris.com. Again, that's metros.nickhaleris.com. Now let's get back to the episode. So switching gears, the other side of that, there's another crowd who, despite life being hard, as you articulated, for people no matter what, who are maybe optimistic to a fault. It's the AI crowd now. It's been different things. It was crypto for a while, and then it's AI and whatever else is coming out of technology. What do you think they're getting right and what are they getting wrong?
Well, okay, so a couple of quick things. I think in most situations, there's always a kernel of truth, right? I'm well known for my criticisms of Bitcoin, but I try to emphasize to people that I actually think that the tokenization of finance, this introduction of digitally native assets, is actually a really, really big deal, right? And so I give people the example all the time of structured products, things like residential mortgage-backed securities, which were critical as a financing innovation in the 1990s and into the early 2000s until they became much maligned, associated with the global financial crisis and the Big Short. And yet we still do them in a variety of ways, right? But the real thing that's interesting about an RMBS is that it requires legally for you to put in storage about 3 million pages of physical documents. You think about companies like Iron Mountain, et cetera. The reason that they basically exist is to store pieces of paper that you've put a little initial on somewhere that then allows those securities that we call mortgages to be bundled together into thousands of mortgages that behave with relatively predictable mathematical properties. When you move to digitally native securities, do I need to store any paper? And suddenly the barrier to entry of structured products falls. Suddenly the ability for me to do really interesting and unique things, strip out dividend payments from corporations and give them precedence within a waterfall, that actually becomes something I can do. I can reintroduce a lot of the heterogeneity that has been lost in financial services. When I came into the industry, we had a huge amount of preferred stock. We had all sorts of different types of things that you may have touched on in your finance classes at various points. Convertible debt, convertible senior preferred debt, et cetera, et cetera. The list went on and on. There were all sorts of innovations that existed or differences in securities that existed that allowed me to construct things in a very different way. Much of that has been lost because of the dynamic of indexing that's basically said you're equity or you're a bond. If there's no natural support for something that's in between the two, it just withers and dies on the vine, right? So there's opportunity for extraordinary financial innovation. That's the part about crypto or digitally native securities and tokenization, that smart contracts, et cetera, all of which play a role in these things that I think are actually super, super interesting. But the entire industry at this point has been totally disingenuous with we're not securities. Of course you're securities. That's completely absurd. What you're actually trying to say is we're not securities because we don't want to be regulated. And I know somebody is screaming at the screen right now, no, the CFTC says that Bitcoin is a commodity, right? The SEC has said that Bitcoin is... No, what they've actually said is it's a financial instrument that's traded on the commodity exchange. It's not a commodity. Right, we actually see this explicitly with things like ordinals emerging on Bitcoin. You can't possibly argue that Bitcoin remains a commodity, a true commodity, once the individual Satoshis that make up a Bitcoin, and everyone who's not tied into the space, what the hell is this guy talking about now? We're talking about the individual Satoshis effectively being tagged and labeled and treated separately, right? So it's just, there's a lot of disingenuousness that's going on in the space that bears every hallmark of every bubble that we've ever gone through. But many bubbles actually have seeds of really important truths to them. The dot-com cycle, really important that tons of money got spent building out communications networks that allow you and I to now do video calls that people would have looked at 25 years ago, but like, there's no way, can't happen. Just can't possibly get the bandwidth across the plain old telephone system, right? The copper wires can't handle it. That's what you would have heard as the bear case in 1997. Today with fiber optics, and more importantly, tremendous advances in switching technology, right? We're able to do things that we thought were completely impossible, or we thought were just the province of the crazy, wild-eyed people who today would be occupying the crypto space or the AI space. The AI space, I think, is fascinating. I think there's an extraordinary amount of potential productivity that's sitting in front of us. But it's also really scary because when productivity hits, it's not like the person who was working on the farm as a farmhand in 1850 suddenly found employment as a skilled tradesman working in a factory building McCormick Reapers, right? No, they became unemployed or they became unskilled workers who were forced into coal mines or very unsafe working conditions. Those dynamics, they were inevitably losers, right? The small farmer was a loser in that process. And handling that from a social standpoint is important. This is the first time we're actually talking about that hitting knowledge workers. Like legitimately the gains associated with AI and knowledge working is extraordinary.
Yeah, and it's actually related to a point you made earlier when we were discussing the fourth turning, which is like, okay, well, if you have a bunch of elites who are already struggling to find a place in society or find a job, AI is a direct threat to make that even worse, right? Holy crap.
Well, I think it's a direct threat, but it also is an incredible opportunity, right? Because at the end of the day, abundance, and I actually just wrote a Substack piece on this, abundance is far more important than scarcity. So elites benefit. By definition, the term elite means that you are scarce, right? There are fewer of you than there are of everybody else. And eliteness in the United States and through much of the developed world for the past 100 years has in one form or another been a byproduct of your education or your unique skills in translating English into computerese. Right now, suddenly we have computers that are capable of interacting with us in a near native English language that lowers the barrier dramatically. I would hope that it suddenly introduces all sorts of alternative mindsets into the technology space, right? Let's bring in the poets. What would a poet do with something that can actually make them much more productive as a poet? Because I know as a hack in the poetry space, right, I can use ChatGPT to very quickly write a love poem for my wife, who at this point is, man, that's amazing. How did you work so hard for it? I can't believe you produced this incredible piece. I didn't. But if a poet, just like a chess master, can work with the computer to produce something truly unique and innovative that hasn't happened before, then we can all benefit from it.
I agree. I'm excited about the potential too. As someone is writing a newsletter, it's hard work to come up with these things. And if sometimes it's a very lonely affair, having something like an AI that you can just bounce a crazy idea off often helps in the creative process. It's cool.
Yeah. In my latest Substack, I actually used AI to very quickly summarize and contrast and compare various authors and sociologists. I couldn't have written 10-page analysis on that without AI. Because I would have literally been sitting there going, okay, I got to go to the library, and I got to find I got to figure out how to work the Dewey Decimal System, which I haven't touched in 30 years. And I got to go into the research stacks, and I didn't do any of that. I sat in my living room and, had an interaction with an AI where I'm like, okay, here's the stuff. By the way, when I write a summary of my stuff, which is incredibly valuable and useful for people who subscribe, I'm not actually writing that summary. I take my entire piece, I dump it through a ChatGPT version 4, and I say, spit back 4 bullet points that summarize this. Now, do I leave that untouched? No. I go in and I edit it and I say, I'd say this a little differently, etc. But holy cow, just stop and think about how much that has changed in just the last 12 months versus what we could do before.
Yeah, so you're optimistic as well about the potential, but maybe worried about labor market.
This is the problem, right? Is I'm optimistic locally. I feel like I will probably survive that. In many ways, I feel it amplifies my capabilities, but I'm also not hiring a young speechwriter or a young editor who might benefit from sitting and reading my stuff and be like, wow, this stuff Mike's writing is really interesting. Here, I'm just going to fix the grammar, but I'm absorbing all this information. I don't need that person.
I saw something on Twitter. It's probably taken completely out of context, but a gentleman who's got an AI company was saying that there's going to be no programmers in 5 years or something. You probably saw that because it was like a meme.
I don't think that that's true, obviously, because what I think will end up happening is that the programmers will just you'll end up with a diffusion of programming capability. Rudimentary programming will be able to be done by basically everyone. In the same way, by the way, that's what literacy is. Literacy is your ability to program your brain using an instruction manual printed on the written page, right? Okay, well, we're figuring that out. I'll tell you, actually, I use this analogy all the time where we talk about the robots are coming. Well, the robots are already here. We're just talking about expanding the roles of the robots, right? We don't think about dishwashers as robots, but that's what they are, right? Microwaves are robots. We just don't think about them in that way. It's automation for a cooking process in which I press a couple of buttons instead of going through the dynamics of, okay, I'm going to hop on a bike, I'm going to pedal really fast so that I can spin a gyrotone so that I can create, various energy waves that are then going to excite the water. We don't do any of that stuff, right? But all of that, if I go back to the 19th century, there would have been a husband who went out and chopped wood that he would have brought home. The wife would have put it into a stove. She would have set it on fire. That stove would have then been used to heat water. It's the same process. It's just I've taken out so many parts of the human labor component in that process now that I don't even recognize it for that. Same thing, Hallmark cards. Like, you want to short something, you can't really, but who's going to want a Hallmark card? I mean, and I could be totally wrong on this, by the way. I just want to be very clear. But man, I can now suddenly send my wife that deep, meaningful message with the exact same little amount of effort that I could when I went out and I spent $5 to buy a Hallmark card. Now I can go log into ChatGPT and say, write her something beautiful and romantic, and she'll receive it and she'll value it just as much as when I paid $5 to Hallmark, which is not really, but it's the thought that counts, right?
For sure. Is she going to listen to this episode?
I certainly hope not. To have her acknowledge that she doesn't value any attempt like that would be disappointing.
Well, I know we're running out of time, so I've got a couple more frameworks that I want to get your take on. So there's another crowd out there. It's kind of two crowds in one, but it's basically people who are either forecasting the dollar's demise or the dollar going to infinity. There's a big following for that crowd out there. What's your take on what they're getting right and wrong?
Again, it just becomes a question of over what time period. Do I expect the dollar to survive another 500 years? No, I don't. Do I expect the Chinese yuan to survive 500 years? Probably not. When you talk about the collapse of the dollar, or you talk about the dollar going to infinity, it's very important to specify against what, right? And so when you talk about a stock market crash, what you're saying is the price of dollars goes up relative to assets that are supposed to deliver you dollars in the future. Right? That's all it is. That's what real estate is. When we talk about a cap rate, that's a cash flow associated with that real estate. The valuation of that real estate has deteriorated because the cost of financing to obtain that in a levered fashion has fallen off. Nobody actually wants to buy real estate unlevered for a 3% return. Right? What they're actually, because you can get better than that by, buying into a totally liquid asset in the form of a US Treasury bond right now. But what everyone wants to do is say, well, I want to invest and speculate about the future direction of things. And oh, by the way, land they're not building anymore. They say as they buy a skyscraper, which is literally human beings constructing various levels of land, right? So like you have all these kind of narratives that I just would just point to and say there's obviously truth to a part of it. I don't think the US dollar is going to survive forever, and I do think the US dollar is likely to appreciate in many ways. On the flip side of that, right, the idea that the dollar is going to go crazy and rise a lot, I actually think that there's merit to that. Otherwise, you wouldn't predict that stock prices could fall or that China could experience significant problems. And I do think that both of those have the potential. Right, China in particular just has such an unappealing prospect where they have built a relationship with the rest of the world where they've outsourced their demand to everybody else. And all of a sudden, everyone else is looking around like, one, we don't trust the Chinese. And two, we have our own shortages of demand that we suddenly have to meet. Why are we subsidizing them in this process, particularly when they behave in a hostile fashion towards us? That's
an interesting point, too. And if you think about which we sort of touched on a little bit, the demographic challenge, if China's looking out selling to a bunch of places where, one, they have a brand problem, but two, they also have a growth problem because nowhere that they're selling really is growing in population, at least not right now. Maybe they try to sell to the global south or something like that, but the global south probably can't afford enough goods to make sense for them.
Well, so this is part of the problem, right? So when we talk about the China price, right? The China price was the price at which China could manufacture stuff. As China becomes wealthier, what we had hoped was that China would be consuming more. Unfortunately, China's population is now contracting, and so the consuming more relative to fewer people to feed, and particularly as they get older, and so they have less aspirational needs, right? Once you're 65 or 70, you've already got your house. You've already got the place to live. You're not suddenly like, man, I really hope to move to the city and experience adventure, right? Like that's just not what you do at 65. You're looking at that dynamic not playing through. And the next price, the global south's price or the Africa price, is so much lower than the China price that you actually recognize that in most situations, global demand in at least dollar terms is likely to contract. You're seeing this in real time when you look at things like television sets. For all the criticisms about what's called the hedonic adjustments for the price of TVs, Nick, how much would you pay me to take an old Sony 35-inch Trinitron out of your house now? Right? You'd pay me a pretty significant amount of money to get that thing out of there, right? And my guess is you pay me more than you have to pay to get a 32-inch flat panel TV by a wide margin. So for all intents and purposes, like TVs are free today, and we're going to exhaust the demand for them. I know I look at my TV situation, and again, having just sold a house, I've got TVs sitting in storage that I'm laughing about because I'll probably never use them.
Total loss by the time you get resettled and you just want to buy a new TV, right?
Fine, I'll pay $600 to get a new TV, right? Who cares?
Yeah. All right. Well, I think we have time for one more question. So for years now, you've been out talking about a very important message. And this might be a completely impossible task given the amount of time we have left. But I'd love to just give my listeners a flavor of it, because I feel like it's one of the most important ideas out there for people to think about when they're investing, which is the implications of the rise of passive on the market structure and what that could mean for investors who are exposed to the markets, either stocks or bonds. And you've done amazing research and work on that. And maybe just if you could articulate it in summary format, that would be great.
So most people are familiar with passive investing, the idea that you can just go out and buy the market index and you don't have to worry about what you're investing in because everyone else has done the work involved in picking those stocks. Their activities have set the price of stocks and you're just following alongside. That's the idea behind passive investing, as promulgated by the John Bogles, et cetera, with an additional caveat that was added in the early 1990s, which is, oh, guess what? Not only is that going to lead to adequate results, but it's going to actually lead to outperformance, because by definition, if you just buy everything in proportion to its market capitalization, you're now replicating the position of all the people who've done all the work without having to pay for any of that work, right? And so your net performance after fees is going to be better. The problem with that model is that the definition of passive in the analysis that is done around those types of observations, somebody is passive if they never transact. Now, that takes a second before you realize, well, wait, how did they get into the market? And how do they get out of the market if they never transact? And the answer is they can't. So we know that this is a flawed model. And then it just becomes a question of how much is it distorting activities in the market or prices that we see in the market when those investors who are perceived to be passive, perceived not to have an impact on the market, once we recognize that they're transacting every single day. And the scale at which they're now transacting is extraordinarily high, right? So my firm, Simplify Asset Management, we've been very fortunate. We've grown to become one of the larger issuers of ETFs just over the last couple of years. We're in the top 30 in terms of issuers. I'm super thrilled, very happy with it. But I always point out to our investors, understand all the work that we've done for the past 2.5 years is the equivalent of 1 day of Vanguard's inflows. Everything that we've done over the past 2.5 years that I've spent 30 years getting my career ready to do is 1 day of inflows into these vehicles. We know that has to impact market behavior. And so a lot of the work that I've done is actually identifying exactly how that's happening, exactly where we should be looking for that. And the fun part is fun in air quotes, is that the academic community and the professional community is increasingly recognizing the validity of these arguments. It has nothing to do with I want you to pay me more, right? Or that it's not fair or whatever, right? It really is just a very simple observation that what we're doing is destroying the process of capital allocation. And so this almost brings us back to the fourth turning type dynamic, right? Which is oh, everything's so hard. I don't know what to do. Well, I'm just going to buy the indices. I'm not going to do any actual work. And by the way, this should all work out great because stocks return 8% a year, or if I use Bloomberg or if I use Vanguard's numbers, 11.5% a year, because they're not using a compound number, they're using an average number, right? And saying that there's no feedback effects on these things. Well, we just know that's not true. And so when we start to do this stuff on a societal basis, and the scale at which this is happening now is what people seem to not fully appreciate. When I started in the industry in the early 1990s, passive strategies were about 1% of the market. Today, they're north of 40% of the market. Once you move to a model in which more than 50% of the holders don't actually employ any form of fundamental information in their analysis, then you start to generate an extreme version of the stuff that we've seen in the past few years, which is basically these meme stocks that rise 500, 600, 700% instantaneously and then collapse, right? At every step in that process, what's actually happening is that there's a relationship between flows and the inelasticity of the next marginal purchaser, which is referring to how much supply and demand change for a change in price, we're just not seeing behavior in markets that is rationally consistent anymore. It reflects the fact that the people that are on the margin doing the transactions are not actually applying any thought process. And that doesn't seem like it's that big of a deal. It's the stock market or it's the bond market. Who cares? That doesn't affect my day-to-day existence. No, it really matters, because what it actually means is companies like Amazon or Google or Microsoft receive an extraordinary subsidy in their costs of obtaining cash that can then be used to determine who to hire or what research projects to pursue or what the priorities are from a political framework through their political donations. Right? All of these things actually really do matter, and we're treating it as if they don't. Right? So we have all this discussion around free markets. We have all this stuff around government shouldn't be able to tell us what to do. And the reality is that we've changed the regulatory environment so that certainly your generation, when they come into the stock market, their introduction to the stock market is through a 401k plan that they default into. They're then defaulted into a qualified default investment alternative vehicle, which is almost inevitably a target date fund. That target date fund is buying into passive bond and equity indices. And so at no point in this process does your typical 28 or 29 or 35-year-old actually have any thought process involved in capital allocation. And we've severed the relationship with the professional portfolio manager who's supposed to be doing that for them. There's parts of it that are good. There's no question that there's been a failure to share the benefits associated with scale that exist within the asset management space. But the low-cost revolution that John Bogle introduced is not at all the same thing as, okay, let's all invest in market cap weighted indices.
As I was preparing for this conversation, I listened to you talk about this. I think it was on Hedgeye or something. And I was thinking about the capital allocation thing. How does that play out? And it just so happened that I was talking to an old investor of mine, and we're doing some recapitalizations of some of our transactions. And I asked him if he'd be interested in investing. And he wrote back in text, "Oh, tech stocks are doing too good. I don't want to do any real estate," which on a micro level is exactly a consequence of this flow inelastic market behavior, which causes those tech stocks to go crazy. And in recent years, every time there's flows, these tech stocks go crazy up and down.
No, I think that's exactly right. I'm constantly doing research on this sort of stuff. And at every step in the process, like, it amazes even me when I look at how much the market behavior has changed. We're just structurally seeing behaviors that we've just never seen before. Or we have stocks like small caps that are just now the extreme version of a tail upon a dog, because the S&P and the mega caps like Microsoft and Apple have grown so much in their size that I can put together all the rest of the Russell 2000's market capitalization in total, right? So again, remember, these are large companies that are publicly traded. They've made it to the pinnacle of, the largest market in the world. They just don't happen to be in that last elite class, right? And the entire Russell 2000 market cap is basically Apple's market cap at this point. That's just astonishing when you think about it.
Yeah, that's crazy. Well, fascinating stuff, Mike. Thank you so much for your time. Appreciate you coming on here. I feel like we covered a lot of really cool ground, and thanks for being here.
Nick, it was a real pleasure. Thank you very much for having me.
Thank you for listening to the Nick Halera Show. We hope you enjoyed the episode and would appreciate your help with spreading the word by sharing with your network on social. And until next time, remember, it's not about pursuing success to unlock fulfillment. It's about learning how to find fulfillment in the midst of success.